Welcome to this explainer. Okay, picture this. You wake up, open your brokerage app, and it is just an absolute sea of red. I mean, not your everyday run-of-the-mill dip, but a brutal systemic market shock where it feels like the floor is literally falling out from under your entire portfolio. Today, we are dissecting the exact anatomy of that kind of market panic. We're going to dive into a fascinating daily log from a trader who is navigating a massive geopolitical storm, surging oil prices, and plunging tech stocks. We'll decode the market logic behind why oil spikes trigger these cascading sell-offs, explore how to strategically price that risk, and most importantly, we'll walk through the exact portfolio strategies you need to actually survive it all.
Is the AI logic over? My first reaction wasn't to analyze, it was to run. I really want you to feel the panic in those words. We've all been there, right? When multiple pillars of the market start collapsing at the exact same time, your brain doesn't naturally want to sit down and do math. The immediate, visceral instinct, even for seasoned traders, is sheer panic. It's that sudden, terrifying thought that the fundamental thesis of your biggest investments might just be dead in the water. You just want to hit the sell all button and run for the hills.
All right, Section 1, Macro Shocks and Market Panic. Let's dive right into this and look at the exact chain reaction, because market panics rarely just appear out of thin air.
It all starts thousands of miles away from Wall Street. First, tensions in the Strait of Hormuz violently reignite. Instantly, the U.S. announces a resumption of shipping blockades aimed at Iran. Because of this, shipping routes suddenly demand a massive 20% security fee on transit. Boom. And the final domino, supply fears skyrocket, pushing Brent crude oil straight over $80 a barrel. So the underlying market logic here behind the rising oil prices isn't just about immediate scarcity, it's about the very real, very expensive risk of future scarcity immediately pricing itself into the global supply chain.
Now, that geopolitical shockwave in the Middle East didn't just stay in the oil markets. It slammed straight into the global tech sector, 15%. That is the staggering intraday drop we saw for SK Hynix, one of the world's absolute semiconductor giants. Just think about that. A 15% destruction of market value in a single trading session. This really grounds our theoretical macro shock in a harsh, terrifying reality.
So how exactly does a shipping blockade in the Middle East cause a 15% crash in a Korean tech giant? Well, it was a perfect storm. You had the initial geopolitical fears combining with those surging oil prices. But then, you add in the toxic accelerant, high-leverage trading. When investors borrow money to buy stocks, a sudden drop forces them to sell to cover their margins, which pushes prices down even further. This vicious cycle got so extreme that the Chaos Ekp, the main Korean stock index, actually triggered a circuit breaker. Total trading halt to stop the bleeding. No wonder our trader just wanted to run.
Okay, moving on to Section 2, Pricing Risk, Oil and Tech. Now that we've seen the sheer panic, let's take a deep breath, step away from that fight-or-flight response, and transition into some measured, objective analysis on the investment strategy of risk pricing.
This brings us to the absolute anchor of today's explainer. Read this carefully. Macro shocks change the price of risk. I want you to let that aha moment sink in for a second. This is the exact moment where pure emotional panic transforms into rational financial theory. The market isn't necessarily saying the world is ending. It's simply recalculating the price of doing business in a significantly riskier world.
So the crucial point is understanding how the market recalculates that price. And it all boils down to this concept, the discount rate. In finance, this is the interest rate used to determine the present value of future cash flows. Here's the chain reaction. On the day of this panic, oil prices jumped an incredible 9.6% intraday. That massive spike acts as a global variable. Higher oil means higher costs for literally everything, which instantly sparks inflation fears. When inflation fears rise, bond yields shoot up. And when bond yields go up, the discount rate applied to stocks, especially high-growth tech stocks, just skyrockets.
And this brilliantly illustrates the most vital distinction you need to make during a crash. On the left side, you have the macro environment, the changing discount rate driven by oil, inflation, and bond yields dragging tech valuations down. But on the right side, look at the actual fundamentals. Are the company's orders disappearing? Are their profits vanishing? Is their cash flow drying up? The absolute key to surviving a panic is recognizing whether the market is just mathematically adjusting the discount rate or if the actual business logic has fundamentally broken down.
Right, let's head into Section 3, Vulnerability of Crowded Trades. Now that we understand the math behind the drop, let's explore why certain stocks get absolutely decimated during these macro adjustments, while others just take a mild hit.
I want to burn this phrase into your memory. Fundamentals do not vanish in a single day. Despite that terrifying 15% plunge in SK Hynix, their semiconductor factories didn't suddenly explode. Their massive contracts for AI memory chips didn't just magically disappear overnight. The business model and the core industry logic of the AI boom were still completely intact.
So if the fundamentals were fine, why the 15% cratering? Because the shock was amplified by the vulnerability of the market itself. We already mentioned high leverage forcing automatic sell-offs. But secondly, these were overly crowded trades. Everyone and their mother was heavily invested in the AI semiconductor trade. When a macro adjustment hits a trade with extreme position concentration like that, everyone tries to rush through the same tiny exit door at the exact same time. The macro shock just lights the match. The crowded, leveraged positioning is the dynamite.
Okay, let's move to Section 4, a trader's systemic response. Let's look at a trader's portfolio strategy and see how a professional builds a framework to navigate this chaos without losing their shirt.
Look at this portfolio breakdown. It reveals a really precarious reality. Notice those cash reserves, only 9.3%. They had recently added a position in Intel, which dropped their available cash below that critical 10% threshold. In a market panic, your portfolio's elasticity, meaning your ability to absorb shocks and maybe buy at lower prices, depends entirely on your cash. When your cash is this low, you have absolutely zero room for error. Tracking point drops in the index doesn't even matter anymore. What matters is that your account has lost its flexibility.
And to make matters worse, the trader recognized a dangerous flaw in their holdings, the risk cluster. They were holding positions in both Micron, MU, and the broader DRAM semiconductor memory sector. Now, on paper, holding two different assets might feel like diversification, but during a macro shock, you quickly realize they belong to the exact same storage risk cluster. They move totally in tandem. It's a great example of how the illusion of diversification can actually be incredibly dangerous when a singular macro narrative takes hold.
So, with low cash and clustered risk, what is the trader's systematic response? It's definitely not guessing the bottom, and it's certainly not panic selling everything. It's this highly actionable three-step checklist. Step 1. Mentally archive this as a macro risk validation day. Basically, observe, don't act. Step 2. Check those storage risk clusters to see if they are amplifying your account volatility. Step 3. Just wait. Wait for stability signals in oil prices, interest rates, and the semiconductor sell-off before judging if your original thesis needs changing. The absolute most dangerous move here isn't missing out on a quick rebound. It's making a forced, panicked trade when you have no cash buffer left. Now, what's really interesting about this slide is how the trader applies this logic locally. When looking at domestic markets, like mainland China A-shares or Hong Kong stocks, they employ a highly disciplined, localized strategy. They refuse to draw massive conclusions for their domestic holdings based purely on one day of extreme overseas volatility. Instead, they just quietly watch the domestic semiconductor leaders. They look for volume, they look for support after a gap down, they separate the overseas geopolitical noise from the actual on-the-ground trading reality.
Which brings us to the ultimate takeaway, the core philosophy of this entire explainer. Macro shocks can remind me to reduce risk, but they can't make individual stock judgments for me. A spike in oil prices or tension in the Hormuz Strait is a phenomenal reminder to check your leverage, check your cash reserves, and manage your risk clusters, but it does not magically dictate the long-term value of a great company. Your systematic, disciplined process absolutely must override your emotional reaction to geopolitical noise.
So, I'll leave you with this to think about. The market is absolutely guaranteed to panic again. It's not a matter of if, but when. So, when the next geopolitical shock hits and your screen flashes red, is your portfolio structured with enough cash and true diversification to survive the panic, or deep down, will your first instinct just be to run? Thanks for diving into this explainer with me, and I'll catch you on the next one.